Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we have another requested stock, and this is Intel Corp, ticker INTC, the chip maker and the company that I probably had one of my worst investing experiences with. Intel was going strong. It came to a peak in 2021 of $63.75, and it's really been on a plunge after that. And a huge contributor to this was them cutting their dividend. And I had invested pretty heavily into this company. I believed in them, and I thought that the foundries that they were building in the US were going to have huge potential for them. So I got up to 100 shares, and then they cut the dividend and the share price completely collapsed. So I looked into it and I sold out because it's not a very good investment. So we're going to look into that and why, and you'll learn from my mistakes and why I changed my ways from a strict dividend investor to more of a value investor with still a focus on dividends, but not as focused as I previously was. Because I used to really just look at the yield and try and get a good yield on my portfolio. And that's probably one of the worst things that you could possibly do. But let's get into the numbers and see what's going on here. Intel's scoreboard is right here. So we have the projections. I'm coming up with a fair value 28 and a quarter, which we're going to give it a 30% margin of safety because they cut their dividend and there just seems to be a whole lot of risk with it. So we're going to widen our margin of safety a little bit, which means that a good price to buy into the stock, if you believe in it, would be $19.75, and you'd want to reevaluate around $24.50 to $25. And here's how the year has actually been. So currently it's 36.61. It had a 52-week high of 37.19 and a low of 24.59. I also did a discounted cash flow analysis and came up with 46.67 would be a good price for these future cash flows of the company. Earnings yield is good. 7.34%, very good, above 5, what we like to see. Cash flow yield, not good. Negative 15.25. They did not have a very good year last year, coming in with negative $9.6 billion in cash flow, which is their first negative across all that we see. Dividend yield, they currently yield about 2% after the cut. Historically, they've been yielding around 4%. So at that time, I was looking for 3.5%. I saw it was a massive company. Most of us have used their products, so I thought that it would be a good investment, and it definitely was not, because last year their payout ratio was 75%. So it was creeping up and was definitely in need of cutting for the future of the company. ROE 7.8%, a little low. We like to see it around 20. Debt to equity does look good, though. This is one of the first companies we've looked at in a while that isn't super heavy on debt. But as they build these factories, they might become that way. Gross profit 42.61. That's good. Historically 53, so it does look like it's a little lower than usual. Net 12.71. Again, lower than usual at 23.48 being their typical, or at least their average over the time period. Revenue growth is just declining. Historically and looking forward, earnings per share, same story. Cash flows, the same. It broke the equation because it was negative on the 2-year cash flow. Share count, they were buying back shares up until they cut their dividend and they started to issue shares. So that's a change that I don't like. Assets have been growing very well, but liabilities have been growing at the same pace. Assets did step up a little bit more recently, though. And then dividend growth, negative with that huge cut. So there's a lot of bad here with the company. I mean, just shrinking revenues alone warrant it to go on the sell list. The share price definitely seems to be a bit high, which would also land it on the sell list. Expenses as a portion of revenue continue to climb. that is a factor that we look at, and if it's climbing, that's a bad sign. So that'd be another sell list item. Earnings, we see declines. They were in the $4 to $5 range, the high fours, and last year they came in just shy of 2. This year they're not even expected to hit $1. So they'll see some bounce back this next year, according to analysts, but it's still not what they saw in 2022. So I feel like this stock is going to take a bit of time before it becomes reasonable to look deeper into. Share count, again, they were buying back shares until they started issuing them again over the course of 2022. Assets, we see some nice growth across their assets, a good amount of tangible assets, almost in line with their liabilities, which is very nice. The liabilities have been growing as well, slowing down more recently. So they have a very strong tangible book value. And that's what I really liked about the company when I looked into it. Their balance sheet looks really good. They have $2.69 on hand for cash, and their ROE. 2022 seems to have been just a bad year for them. They typically come in right around 20. So that 20 mark is the lower end of what we do like to see. If they can get back to that range, then that would be a whole lot better. And you can see the dividend was cut here. When we get to the actual trends, you'll get a better view of that. So what we're looking at is the majority of the value coming off the balance sheet, which we see on quite a few companies recently. That's followed by the dividend and then the earnings, and then cash flows were negative, so they were really dragging it down. But this next year, it's going to be, or this year on projections, are going to be strong balance sheet with some decent growth and cash flows if they can get back up to their traditional cash flow yield of 11.8% at least, which would be towards the lower end of what we've seen. Earnings are not contributing a lot of value, very low earnings, and that gives us a fair value of 31.15 with a current share price of 36.61. So again, we want an even wider margin of safety for a company like this, where they just cut their dividend, they started issuing shares again. Clearly something is wrong and they're trying to pivot and fix it. So my whole thesis changed on the stock, and I sold out. I took a loss, but I will admit that I made a mistake in buying in so heavy on it. When I look at my actual personal valuation for this company, I'm looking for something more around $24 is what I would be wanting to pay for a share. So definitely lower than where it sits today, more in line with what it sat at last year. So financials, we see revenue, when we stick a trend line on there, is on a decline. And that's what we saw on the scoreboard, year over year shrinking and projected shrinking going into the future, while cost of goods is staying very stagnant, if not climbing. So that's very, very bad sign. EBIT net gross, EBIT, we see a decline, a pretty big decline, especially from 2021 to 2022. Same across net and across gross. We see 3 years of stagnation essentially, and then a drop off for all of these. The balance sheet, we see some good asset growth, some good tangible asset growth. Liabilities, we see some very big growth there as well, but the tangible book value is growing very quickly, almost up to the point that the liabilities are. Cash flows, this is definitely not a good story here. At no consistency, and it's just not what we want to see, especially having negative so recently. Dividends, they were good at growing it, then they cut it, and it's just not looking good for a lot of reasons. And here's everything graphed, and you can just see the declines of essentially everything aside from the balance sheet, which continues to improve. But the share price is sitting here, while the majority of the values are sitting down here. So I'd say this stock is overvalued, and with what we're seeing on the earnings, the revenues, the everything, definitely going to be a sell. I'm going to give it 1 to 2 years to turn things around, and then I would be interested in it again. But for now, it's going on the sell list. So I want to thank you guys for watching. Please like if you enjoyed the video, comment if there's any other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.